Hey, it's Mike from Apollo, and I am going to introduce you to an AI startup that loses money every single time you use it. Welcome to Fictitious AI. This is really an experiment and an investigation into this big question of, is the business you're building, is the startup, is the product that you're building viable? Is it worth building? On one side, what does this customer demand look like? And is it balanced? And is there integrity with how you not only provide value to them, but how you capture value in the bank account with cash? How you actually capture value rather than giving it all away. So the crazy thing is with Fictitious AI is it's really me showing you an example of like the hot startups of this moment. In this case, what I really want to do is show you that even if companies like Fictitious AI are raising lots of money, that doesn't necessarily mean there's a viable business. I've got a number of tests and scorecards and evaluators that I want to show you and show you exactly where it all goes wrong and some of the implications for it. So Fictitious AI, skip all the links, ask anything, get a structured, cited report, synthesized from the web in seconds. So you can just jump in here and you can ask it anything you want. So here's an example on carbon pricing. Bit of a thing right now, the taxes, cap and trade, getting permits and licenses. In fact, I actually have been working on a project that's all about, trading of licenses, and hugely interesting kind of new system, new economy, new market. And look at this. In this case, Fictitious AI, it's giving us a great breakdown, okay? And it cites it like World Bank, IMF. All right, this is a lot of value, saves me a lot of time. So it's good for, what are the use cases? Research, coding, study, business, probably a ton more. 40,000 active, 6,000 pro members. This is quite interesting, asking over 20 questions each and every day. So we'll use that as a metric and look at the reports as it goes against it. There's a free version, sound familiar, and a pro version as well. Okay, Fictitious AI doing their thing. And really, you could imagine the pitch going into an investor. You'd be saying things like, it's Google but better. It's what Google should have been. All of those themes of, the next generation. This is Web 3, Web 4. So you can imagine how you might pitch this to investors and to customers as well. But let's actually now jump into the reality behind a business like this. So what I'm showing you is look at the unit economics of Fictitious AI. Now, unit economics are one of three areas that you want to look at when you're really playing with ideas of profit and financials on an early stage growth company and startup. One of the notes I've got here is it's very similar, actually. If you think about growth, you usually have top of funnel, mid funnel, bottom funnel. Kind of interesting that for the finance side, on the other side of growth and customers, over here on profit, we've got unit economics, cash reality, and scale and profit, the third anchor. And I'm going to show you all of those. So it's interesting how those systems of three seem to play out a bit. Okay, so we're delivering Fictitious AI. Let's have a look at what the unit economics do, because this is the specific unit measure that you should always go to as the starting point to the question, is this a viable business? So on one side, the customer's paying $20 a month. That's quite a standard SaaS-like, subscription-like pricing. What's really interesting is a lot of AI services do tend to have one of their earlier lower pricing models in and around this level. Now, what's quite interesting though, because I wanted to choose an AI company because we've got a different set of economics playing out here. This is like tokenization, token economics, which not only affect costs, actually, they may be, in fact, the new paradigm of pricing towards the customer as well. But the reality is here, and I don't want to get too lost in the numbers and the spreadsheets, but if you are serving more than 20 queries a day to a user, that's roughly about 2,000 tokens per day. That 2,000 tokens includes inference, all the tooling, a whole bunch of things that kind of all compile in to make a tool like Fictitious AI. Now, the reality is 20 a day, 2,000 tokens a day is actually going to add up to well over $20. Actually, it's going to be closer to $30 a month to serve that engagement. And the reason I'm doing Fictitious AI is a lot of non-AI companies are putting AI into their products. And there's a big watch out here on unit economics. And then there are companies that are pure native AI companies or AI first companies. So a lot of things are done from AI. So they're not served from fixed web apps. They're actually generating queries every single time. And that has an inference to tokens, and tokens cost, and compute is expensive. We're building a lot of data centers. We're making a lot of chips. We're training a lot of data. That whole stack of AI, all of that is contributing to a cost. So what's really interesting here, when you look at what we've got on the screen here, we've got 20 in rev, but we've actually got $30.60 in direct variable cost. So the contribution margin from each user is negative 53%. And this is really, really dangerous. This doesn't factor in some other variance, shock, disruption, but we're really looking at here some really challenging basic math. So what you can see here is that even just on this direct, and we're not even factoring in indirect costs, there's a real flag here. And as you can see, the app is like freaking out. We got fail, 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 and flags are starting to run. And this is one of 3 evaluations that we've done on Fictitious AI. So I'm now going to go to the next step. And hopefully, as we go through these, what you're starting to do is ask yourself, for your company, for your startup, for your product, what are the unit economics? And if you have those questions, stay till the end, because I'll show you how you can solve and address these, measure these for yourself as well. Okay, step 2. So we've kind of got the unit economics. Let's now look at cash. Cash comes after that. And the reason is, you've got revenue, you've got investors putting cash in the bank. Now, Fictitious AI has raised a little bit of money. So there's 2.4 in the bank. So this is sort of late seed round. Yeah, definitely a seed round for AI. And one of the things I want to point out here, you would, at first glance, you think, oh, great, 2.4 in the bank. We've got ages. Well, look at your monthly burn. And on a hardcore calculation, that's only 15 months. For an AI early stage company, that's not bad. I mean, it's not amazing, but it's not bad. Once you put in some, like a stress runway, you have some unforeseen built in there, the numbers really start changing a little bit, and you're getting closer to a year, and before you know it, it's 9 months, 6 months. But here's the really crazy thing. You can't even rest easy going, great, we've got 14 months, because that would be based on those 6,000 pro users, those 40,000 regular users that I mentioned. What would actually happen here is, as this business grows, it has less time to survive. And this is complete insanity. This is like not how a company should work. Traditionally, more customers equals more cash equals more runway, more time to survive. Well, actually, with Fictitious AI, every customer is losing money. So more customers, the bigger the loss. So think about it. If you had a SaaS product and you threw some AI in and lots of your customers adopt it, you might be actually burning through your profit that you generate. You might be compressing your time that you have, your cash runway. Or if you're a pure AI startup, you may in fact not realize that you're looking at the cash in the bank, 2.4, great, we've got ages. But no, hang on. You have, according to this, 14 months. If you do not add another customer, guess what happens? Every startup is focused on growing its customers. So if you double the customers, you might halve this runway, which would be 7 months. So you see here that the imbalance that we had at unit economics, and remember, it was only direct costs. We move across over here and we have a look at the cash reality, the runway of this business. And actually you've got a situation where if your marketing and growth team do a good job, you're in bad shape. And you get in worse shape the better they do. So this is massive conflict around how you think about viability and profit and unit economics. Because the crazy thing is, if you were speaking to an investor right now, they would just wait 3 months and your situation would be far worse and the terms would be better. That's one thing. But more importantly, there would be no light at the end of the tunnel. And this is an important concept that I'll show you in this next one. So let's have a look here. I mean, this is where the app really freaked out. It called this business brittle and unsustainable, and I don't blame it. There are flags all over the place. But the thing that I was going to point out to you is it has no ability to self-fund. So if you think about raising capital, that puts you in a terrible position relative to your venture capital firm. But more importantly, maybe you shouldn't need to continuously raise. Or alternatively, imagine going to raise capital, but you technically don't need it to survive. It changes how you think about your capital strategy, how you might allocate it, how you might generate it. This business also has this crazy situation when we think about the durability of the business. It's got compounding effects, but all in the wrong way. Usually we want like these compounding network effects. This has got none of that. And there's real challenges. You might actually also to have some challenges where you are depending on one vendor. Vendors might change their prices. So there's a lot of challenges here around survivability, durability of the business. Certainly, scale and profit are not even on the cards for a business like this. So what we've done is we've had a look at, let's go back to this beautiful homepage. I mean, it just looks so nice. Fictitious AI. I mean, you can ask questions, you get these great answers. There's even like a free version. It's only $20. I mean, what's not to like here? But actually, once you do these numbers, it shows you like not every user is a good user. Not every business is a good business. And what we saw here is this crazy situation where the growth is actually killing the company. And here's the thing. So we know it's a brittle and unsustainable business. The great news for you is I have built this free tool that will help you evaluate. In fact, all of these reports came from this tool. This tool is ProfitBooks. You can access it at b2bprofitbooks.com. Link in description, all the notes. You know the drill. But look at this. It'll evaluate your unit economics, but wait, it will even jump in and break down and provide you an operator for all the component parts to help you improve it, retest, and over time, you can get your unit economics back in shape. Same thing with your cash reality. For example, let's have a look here. It'll help you calculate the length of it and improve that. It starts to get into like working capital, what's really contributing to your burn. And lastly, over here on scale, as you saw, fictitious AI, very brutal. We can improve our durability. We can improve profits, margin under different behaviors, and if you scale. So there is lots of opportunities not to be like fictitious AI. You don't want to be a company that loses money every single customer, because there's no growth that will solve that. So head to b2bprofitbooks.com, use the tools, give me your feedback. What are you learning about unit economics? How are you answering this question? And this is really the big one. Is the business economically sound? All right, I hope that was helpful. Catch you next time.